So a lot of people think that a bank wants to see either a PAYG income or a self-employed income in order to prove debt servicing. But there's a whole heap of other incomes that can be used to service debt. I've just had a client and helped a client out by the name of Wendy. Now, Wendy was referred to me by a local business coach. And Wendy's situation was Wendy was trapped in high interest rate loans that she'd had for many, many years. And Wendy had been told on numerous times that, hey, you don't have a job and you don't have a self-employed business, therefore you can't service the debt that you need. Unfortunately for Wendy, some time ago, an event happened and she got an insurance payout that then provided an annuity. And the annuity goes for quite a long time, enough time to prove to a lender that we could use it to service debt. So what we were able to do in Wendy's situation was be able to show a lender her source of income, how long the income was going to go for, how long it had gone for, the consistency of that income, so that a lender could be comfortable that this was an ongoing source of income and could be used for debt servicing. Once we were enabled to tick that box, then we could refinance Wendy's current investment property loans and get them on a much better deal, put them back onto interest-only terms, and make a massive difference to her cash flow on a week-to-week, month-to-month basis. So I guess this is a situation where you should never take no for an answer and continue to ask questions. If you're a property investor and you've managed to secure loans at some point in time in your life, and for whatever reason your circumstances have changed and you've been told maybe once, maybe twice, maybe numerous times that you can't facilitate a refinance to get better rates and your current lender won't offer better rates, look, never give up. Keep asking the question. If your situation overall makes sense to a lender, then a lender out there is probably going to have the appetite to take on the transaction. In this particular instance, it was the client had always been told her income was the problem. Now, yes, not the perfect income, but also you've got to remember that credit assessment isn't just about that one thing, capacity to borrow. Credit assessment is about character. Client had always made good payments. It's about collateral. The client had blue chip properties in great locations. It's about capital. The client had a very low loan to value ratio over her properties. And it was about the last C of credit, which is common sense. It made sense that the client's income was steady. It made sense that the client could service her debts. And it made sense that the bank would not be putting itself in risk by extending the client the money to refinance the loans and at a better rate than what she currently had. And it made sense that the client was going to be in a better situation if the bank was able to do it. If you're thinking about doing some borrowing in the future, or you want a better deal, or you're trying to get more money, don't give up. Think broadly about what your situation looks like. Think about the 5 C's of credit. Think about what a lender is looking for and what would make sense to a lender. And the great thing about lending in Australia is there is more than 30 or 40 different lenders out there that all have their own individual credit policies and departments. So somewhere in those 40 lenders, there's probably a lender that likes your situation, that understands your circumstances, and that is prepared to put their neck out a little bit. Always remember the story about Walt Disney. He got knocked back from nearly 100 banks before someone gave him the money for Disneyland.